Oh,
All right. Good afternoon, everyone, and welcome to our Learn at Lunch webinar series. Today, we will hear from Dr. Kim Anderson as he discusses the grain market. If you have any questions, you may ask them through the chat window by clicking the chat button at the bottom of the screen. And you can find more farm financial management information at the eFarm Management page. I will share the link to that in the chat window. Our next webinar is scheduled for June 4th at noon, and we will hear about prospects for double cropping. Dr. Anderson, I will turn it over to you now.
all right. Thank you, Brett. Let me see if I can get this. How's that look?
That looks good. I see the full slide.
All right. Well, as I like to say, you asked me to do a day-long workshop. I can get ready for that in a couple hours, but you asked me for about 20 or 25 minutes. That's going to take some work. I could have went several ways on this presentation. I chose one. I do have some slides in here that I'm going to go through relatively fast. There's some information you may be interested in, and if you are, you can come back and look at the tape. Or Brett has my PowerPoints, and he'd be glad to email those to you. Or if you'll email me, I'll send them to you, and that way you can look at the underlying information. I'd like to start out by looking at fuel. I've got this chart from 2007 through into 24 for diesel. This is the U.S. average diesel price. I just want you to see how prices have changed over time for fuel. If you overlaid the gasoline chart, it would look just like the diesel chart, except several, 40 or 50 cents less than the diesel. But you'll see the peak we got in 2022. We backed off of that about a third of the way back down. We're not as low as we was back in 18, 20s, and 21, but we have fuel prices have came down. If you want to look at fuel prices in Oklahoma, now these are available on gasprices.aaa.com. And then if you want Oklahoma /state = OK, and you'll get the, well, I think I could just click on this. And voila, that's what you'll get. And then you can look at any county and get your prices, and you have both diesel and fuel prices down there. So anyway, that's just some information that you might be interested in if you're wondering what's going on in fuel prices. I think what this shows is that for gasoline or diesel, prices haven't changed much. Diesel's down about 15 or 20 cents from last year, but gasoline prices, where they varied 15 or 20 cents up or down, they've averaged somewhere around $3.10, $3.11. Your farm diesel, check this, last week it was $3.18 on the average, around the state anywhere from 308 to 349. If you're looking at fertilizer prices, MAP, DAP, urea, potash. Now MAP is 10,050 and DAP is 18,046. Your MAP's about 827 a ton, your DAP around 780, urea for 576, and potash for about 513. You can see that they were quite variable coming into 24. They've stabilized with urea, potash, and DAP a little lower. Your MAP has increased back up. If you look at your anhydrous 10340 and UAN 32, your anhydrous has increased about $160, $170 over the last few months. It's around $800 a ton right now. And now this is liquid, of course. Your 10340 is around 600, and your UAN 32 is around 400. That just give you an idea of what's happened in the fuel and the fertilizer markets. Let's get into our wheat markets and wheat, corn, sorghum, soybeans, and cotton. A lot of numbers here. The important numbers that we want to look at are your cash prices, your forward cash, and your average Oklahoma prices, and your stocks to use ratios over on the the far right there. Your Oklahoma crop insurance and your predicted by USDA, that is of some value. But right now, and wheat was up 15, 18 cents yesterday. It's lost, well, it was up about 27 cents yesterday. It's lost about 15 of it today. So it's popping around quite a bit. These are concrete prices for wheat at $6.43 for cash and forward contract for harvest delivery. If you go to Perryton, Texas, or the Panhandle, take about 15 cents off of that. Weatherford is about 20 cents below this, and Snyder, Altus area is around 35 cents below the concrete or northern Oklahoma prices. Want to point out that your USDA is predicting an average price for wheat of about $6 for the 24-25 marketing year. Oklahoma prices normally run around 20 cents below that. So the USDA is predicting about an average price for Oklahoma wheat, which is around $5.84. If you look at the stocks to use ratio, and we're going to concentrate on that a little more as we go through these, you're looking at for wheat in the United States, just about an average stocks to use ratio. So you'd expect about an average price. On corn for harvest delivery, the current cash is $4.44. Harvest delivery is $4.75. Your average Oklahoma harvest price, my little roller is quite sensitive here, and I have a tendency to play with it. Now these are your Oklahoma average prices here are like wheat is your June, July, and August average price. Daily prices from 09 through 23. Corn is August, September, and October. Sorghum is August, September, and October. And soybeans is October, November, December. And cotton is October, November, and December. So you look at corn prices, you're looking at right at average for forward contracts. You look at the stocks to use ratio, it's projected to be slightly above average at 14% versus 12 on the average. Your sorghum, 459, forward contract 445, average 460, slightly below that. You're looking at average stocks to use ratios. Soybeans, you can forward contract for 1131. Your average is 1080, so above average price there, with above average stocks to use ratios, 10% versus 7.5. Your cotton, I got a range there, $670 depending on $70 depending on your grade. Forward contract, I think, is really around 73. You've got to look at that contract. Depends on what that basis is doing. Right now, it's relatively weak. Your Oklahoma average is around 74. USDA predicts 74, and your stocks to use ratio is right about average, slightly above average. But that sets the stage now for looking at these crops. Now, this is what I call the smoke and mirrors part of anticipating what prices are going to do. And for the 42 years that I've been doing this, I've been using the ending stocks as an indicator of prices. I think over the last few years with what's going on around the world, that the stocks to use ratio is significantly better at predicting price or anticipating prices than the ending stocks. Now, the ending stocks will get you in the ballpark, but this shows world ending stocks slightly below average. You've got for 24, you've got a record crop predicted at 29.3, but also record consumption, both well above average. But if you look at the ending stocks, I'd tell you you'd have slightly above average prices with these numbers. But if you look at the world stocks to use ratio, it's projected to be about 31.5%, and your average is 34. So your stocks to use ratio and your ending stocks, both in the world, indicate slightly above average prices. You look at the United States, again, what's important really is 23-24. We're building stocks expected for the 24-25 marketing year, and we're predicted to have lower prices. Now, this is the average U.S. price at $6. That imply about $5.80 for Oklahoma. These your stocks to use ratio, or your ending stocks are below average at 850 million bushels. And if you look at all wheat, it's projected to be at 40%. Let me just go down to here. 40% stocks to use ratio, and the average is 41. So that's, if you look at the world, it's slightly below average. If you look at hard red winter wheat, they haven't released the hard red winter wheat numbers and won't until next month. But what prediction I have is up around 50% or average. So what that tells me on wheat is that this forward contract price of 643, which is above our average price of 584, may be just a little high because our stocks to use ratio is right at average. So I think it's telling me that we should expect in the 24-25 with current numbers, average to slightly above average prices. If they will, I think, as I'll show you in a little bit, go below average, and we'll talk about that in just a minute. The important thing is when to sell wheat. And I think this chart tells you, and this is the average prices, average monthly prices for Oklahoma for your June, for your marketing year, June through May. And you'll see that the average June, July, and August price, now we've taken off 5 cents a month for storage and interest as we go on out through the year. But you can see, once you clear August, you've got a good 25-30 cent price discount just from August to September. And this chart tells me that it's a no-brainer unless you can predict prices, and I don't think you can, you want to sell your wheat in June, July, and August. Now, if looking at corn, again, we're going to go through this a little faster because of time. We're looking at not a record crop, but a near record crop for the world corn. You're looking at the ending stocks. It's at 12.3%. If you'll remember earlier, we talked about world ending stocks for corn on the average being for the stocks to use rate being at 24%, and the stocks to use ratio for 24-25 to be at about 26%. So what you're seeing here is average ending stocks and just slightly above average stocks to use ratios, which tells me if I'm looking at the world market, and it is a world market, that I'd expect slightly below average prices for corn. If you're looking at U.S. part, you've got ending stocks at 2.1 billion for next year, 2 billion this last year, slightly lower prices. The ending stocks are well above the ending stock average. If you look at the U.S. stocks to use ratio, your average is 11.5%, and your average U.S. is 14.2. So on corn, what are we looking at? Well, slightly above average world ending stocks, well above average our stocks to use ratios and ending stocks for the U.S. You look at what the market's offering right now, forward contract at 475. Oklahoma average harvest for 09 through 23 is $4.80. So this is almost I'd expect your corn prices to be slightly below average based on the numbers that we have right now. The projected U.S. stocks to use ratio at 14% versus 12 tells me that, and the world supports it with average. So I'd say right now, of course, things are going to change a lot between now and the corn harvest, and that we're just now putting it in the ground in most areas of the United States. We've got a long ways to go, but this is the foundation for what you'll be looking for your corn prices. If you're raising corn, it gives you an idea of what you're going to get paid for it. If you're buying feed for your livestock, it tells you that you'd expect average to slightly below average feed prices as you move into the 2024 winter. Soybeans, as you get in, if you're raising beans to get into that, or if you're buying protein feeds, it's going to give you an indication of what to expect for that. Looking at the world, let's just go to you're looking at record production, 15.5 billion, record consumption at 14.8. So you're going to build stocks, which you do. Your ending stocks, 4.7 billion, are well above the 3.8 billion average for soybean ending stocks. And if you look at the world stocks to use ratio, it's projected to be 31.2% versus 27%. So the stocks to use ratio and the ending stocks both indicate above average soybean supplies in the 24-25 marketing year. Looking at the U.S. numbers, you don't have record production, but near record. You had 4.5 billion in 22, 4.4 in both 17 and 18, and 4.4 projected in 24. Increased ending stocks slightly above the 430 million average, and they've got your projected price to be less than last year, which you'd expect, and right at or slightly above the average soybean price. So if you're looking at the numbers, and I think these are what you want to look at as you're looking out into the next marketing year, either for protein feed cost or for price of beans. You've got the U.S. stocks to use ratio, 10% versus 7.5, well above average. You got the world at 31 versus 27, above average or well above average. And so you'd expect a below average price. But right now the market's offering $11.30 for it, and our average soybean price from 09 through 23 has been $10.80. If you look at what the USDA is predicting, it's $11.20, and a stocks to use ratio, like we said, of 10% versus 7.5. So this tells me that bean prices might be a little high right now, but I've watched a few market analysts in the last week or two, and one of them was talking about $12 or $13 beans. He thinks that the USDA is underestimating the demand for beans, especially in the export market, out into the 24-25 marketing year. That's a possibility. Also a possibility, we're a long ways from getting the beans harvested in the northern hemisphere, United States, or in the southern hemisphere of Brazil and Argentina. And China is always the gorilla in the China closet, or elephant in the China closet, whatever you want to talk about it, that could change it. But right now, the market's often slightly above average soybean prices. Looking at cotton, same thing there with the U.S. cotton situation. They're predicting around 74 cents, 76 last year. The average is right at 74. You look at your 7-year average cotton ending stocks at 4.3%, projected to be 3.7, so below average ending stocks for cotton in the United States, and really an average price predicted there. So do you think cotton prices might recover a little bit? If you're looking at the world, you're looking at above average ending stocks, 83 versus 82, with relatively good production out in the world. Bring it down to the bottom line numbers. The United States stocks use ratio, 25% versus 23%, so above average there. And the world stocks use ratio is right at average. So this tells you that you'd expect around average cotton prices, which is around 74 cents. And right now the market's probably priced right at that price. And the USDA is predicting 74 cents. So right now, cotton prices, and really all the prices, save soybeans, are consistent with what you see in the historical and the projected stocks to use ratios, and to a certain degree, the ending stocks. All right. Brent, that gave you about 20 minutes worth. Got any questions or comments?
So I don't see any questions right now. It is set where people can unmute themselves to ask questions or ask questions through the chat.
Okay. So if we don't have any, then let me see. Did I get it back to share screen? No, I didn't.
Yes,
Here we go.
there.
Let me just end up with my philosophy. I'm going to end with this. What you need to do, it doesn't matter if you're selling a commodity or buying inputs. You need to take the emotion out of it. You've got variability. I think you need to have a written plan. I tell the story of I think it was back in 2008, something like that. A farmer called me. Wheat prices had been up over $9. They were back down in 760, 770. And he said, Kim, will prices get back to $9? And I said, I don't think so. I said, you probably got a 10 or 15% chance of wheat prices getting back to $9. And he said, well, if they get back to $9, I can buy a new equipment. He said, that might sound bad, but I'm driving 1984 equipment. And we talked a little bit and then hung up in October. And this call happened in July. And in October, I kept watching his elevator, and that elevator price got to $9.03. It was 903 one day, 905 one day, and then back to around 902. And then it went in the tank, as you'd expect. And I waited for him to call me and tell me what happened. I didn't hear from him. So after a couple of weeks, I called him and I said, well, did you take it? And he said, no. And I said, why? And he said, well, they were saying that prices would go to $10. Now this is a true story. You need to write it down. When early in my career, I got a deal from Doan's Market Advisory Service, and they said, if you will write down an objective, it increases the odds dramatically that you'll reach the objective. And so I wrote down, I'm stuck it on the board, that I wanted to increase my salary by 50% in 3 years. Just wrote it and stuck it up there. You can't not only got to do that, you got to have a plan on how you're going to do that. 3 years later, I had increased my salary by exactly 50%. It just seemed, I find out if I will write it down, I have better discipline to follow the plan on what I got to do to complete that. You got to, as a producer, concentrate on producing a quality product that the market wants. And that if you do that, price is going to take care of itself. Now, you've got to be wise about it. Like with wheat, I think it's a no-brainer to sell in June, July, and August. I also think it's a no-brainer that you got to stagger it on that time, because I have research that shows that from the bottom price to the top price in the June through August time period, August 30, is $1.83 from the bottom price to the top price. That's the average. The high is about 360 and the low is about 80 cents in that period. There's a lot of variability during harvest. So I say stagger it in over June, July, and August. Rarely will you sell or buy at the top or bottom of the market. And that's why I like dollar cost averaging. So use the market because you're not going to beat the market. And with that, I'm done.
All right. Thank you, Dr. Anderson. I did share a link to the CERT webinar survey. So if everyone fill that out, I appreciate it. And I see a question from Brian Adam.
Brian.
Do you think that soybean prices are higher than you might expect, given the stocks use ratio, in part because of the renewable diesel markets?
Oh, Lord. I had a guy say that to me once. He came in and said, oh, Lord. And I said, bless you, my son. Anyway, boy, that's got to have a psychological impact on farmers not selling beans. And that, I think, might have prices up there. Brian, after 42 years of this, I don't know. I know less than I did when I started, I think. I believe that stocks to use ratio tells me both in the world and the US that we should have prices. However, you've got risk in the market. You've got those processing plants coming online that could increase the demand for beans in certain areas. That's definitely going to change the basis in those areas. But we're still in a world market. And over the long haul, I think the world market's going to drive prices. I believe the risk that's in the market right now, you don't know what's going to happen with Russia. You don't know Russia, Ukraine. You don't know what China's going to do or what's going to happen in the economy in China. You don't know the production as you look at the United States or Brazil or Argentina or whatever. So I think there's more risk in the market right now. Maybe especially in beans, also, the demand for pork and your relative to beef and trying to pork. I think that may be why we got a slightly above average price. What do you think? You're the guy with the numbers.
I can't say anything.
Yes, that's true. I've got you on there. I've been meaning to send you an email and say, I really enjoy the Wall Street Journal.
Good.
Yeah.
Hopefully you enjoy the Outlook reports when they come out in a few minutes or a few hours, whatever it happens to be.
Okay, well, I do, and I still, and I know you've heard me say this before, I don't understand why you don't give me hard red winter wheat numbers in May. You make me wait until June for them. But, I understand policy's policy.
I will raise that issue again, as I did maybe 2 years ago when we talked about it.
Well, you got to have the numbers because you got the total numbers. So you've got to have those estimates. They're saying, well, they're not very accurate right now, but I don't care. A number's a number.
That's true. And I think they do have the numbers. I think they're probably just not confident enough in them to share. So I'll see what I can do.
Okay. Enjoyed talking to you, Brian.
Good to be here. Thanks.
Well, thank you again, Dr. Anderson. Thank you everyone for attending. Our next webinar is June 4th at noon, and it will be about prospects for double cropping. So we hope to see everyone there, and thanks again. If there's nothing else, I'll end our webinar.
All right, bye now.